Okay, sorry. Where this is chapter, I'm going to start a little bit over again. This is chapter 3 of Gapenski. We're going to be talking about financial accounting. Sorry, I wasn't recording, so I'm going to start just very briefly rehash what I just said. Financial accounting is the language of business, and what we're talking about is that first step of acquisition of capital in the financial markets, right? And the first example that I'm talking about is the acquisition of capital from lenders. Okay, so, and the first example of a lender is a commercial bank. And what I said was a commercial bank is called a financial intermediary. I'll write that down. Financial, you should know this language. Financial intermediary. And what that means is, what I was saying is, Caitlin has a job where she earns some money. She has excess money at the end of the week. Some of the money she earns from her job, whatever it is she's doing, she keeps and spends. Some of it she deposits in the bank, right? Along with her friends Allie and Deb, they all deposit their money into the bank. What they are really doing is making a loan to the bank, right? And then the bank takes that money and says, thank you very much, ladies. We're going to pay you some amount of interest. But the bank has to, in order for the bank to be able to pay interest, the bank has to earn money. And so what the bank does is it turns around and it makes loans to people like Jess, who said, Jess comes in and says, I want to buy a house. I can't buy the house without some additional cash. Bank, would you please lend me the money? And the bank says, sure, we have a pool of money and we will lend it to you, right? And that pool of money, what the bank is really doing is lending Caitlin's and Allie's and Deb's savings to Jess. And so, but they don't tell Caitlin and Deb and Allie that that's what the bank doesn't tell the depositors, this is what I'm doing with your money. I'm making a loan to Jess, right? Deb and Caitlin and Allie just have to trust that when they come back to when they go to the ATM machine, that there will actually be money for them to take out. What the bank specializes in is assessing risk, right? And I kind of talked about this, I think, previously, but what they do is their specialty is assessing risk, right? So they evaluate, they make a judgment about Jess. When Jess comes in and says, I would like to borrow money, the bank says, okay, let's see a bunch of information. I don't know if any of you have, you probably haven't had to do, you've maybe taken out a loan for a car, I'm imagining. That is nothing compared to getting a loan for a house, right? It is, getting a loan for a house is like getting a proctological exam. It is a really unpleasant process. Basically, to get a car loan, you just have to show, they basically just check your credit score. But if you're going to get a large loan, several $100,000 to buy a house, you go through a rigorous evaluation process so that the bank can decide, are you a good credit risk or not, right? So the bank specializes in this kind of knowledge. And so they examine Jess's credit worthiness. You know, they of course check her credit scores, but they also require a whole bunch of other documentation from her employer. You know, they look at her tax returns. They decide, has she had a clear, steady income over the last several years, right? They make all these kind of they do this process to determine, is Jess a good credit risk, right? Is she likely to pay back our loan if we make it to her? And the higher the likelihood is that she's going to pay back her loan, the lower her interest rate is. And we'll talk a lot more about that next semester in finance too. We'll talk about where does this interest rate come from? You know, how does the bank come up with, well, we're going to lend to Jess at 6%, we're going to lend to Emma at 4%, and we're going to lend to Chloe at 8%. How does the bank decide that, right? So we're going to talk about that next semester. But for now, what you just need to know is banks are specialists in doing this, okay? So they assess Jess as being, say, an average credit risk, and they say, we're going to give you the average rate, let's say 6%, right? And then they make that loan of Caitlin and Allie's and Deb's money to Jess. right? And then Jess pays the bank back at 6% interest, and the bank turns around and pays Allie and Deb and Caitlin 3% interest, right? And the gap between that, right, the 3% that, the 6% is coming in, 3% is going out, that difference is how the bank makes its money. Right? That's how the bank makes its profit, is the difference between the interest that they collect and the interest that they pay out. The bank is a financial intermediary. It could be, right? It is possible that Jess could say, my friends, Allie, Caitlin, and Deb, I wish to buy a house. Would you loan me the money so that I could buy a house? Well, now we have this kind of messier situation, right? Allie, Caitlin, and Deb have to all figure out, is Jess, even though we really like her and we like to go out partying with her, is she worthy of us lending her the money? We all have friends that we adore and love to spend time with and are a lot of fun, who we would not lend money to, right? If there's a saying that never lend money to a friend unless you're prepared to make it a gift, right? So, there are friends who they'd be like, hey, can I borrow $10? I'll pay you back next week. And you're never getting that $10 back, right? We've all had that friend. So the question that Deb, Caitlin, and Allie have to say is, we adore Jess. She's our good buddy. This is serious dollars, though. This is not the $10 that she borrowed last week. This is a significant amount of our savings. That is a process that then each of them would have to go through to determine the credit where they would have to all make kind of that one call. So what financial intermediaries like banks do is they eliminate that process from you, right? They do the process of the credit assessment, and oh, by the way, they take the risk too, which is some of what we were talking about with similarly to insurance, right? Insurance companies collect money into a pool. We talked about that last time. And then they take the risk, right, away from the insured participants, right? They take the risk away so that when something goes bad, because with insurance, everybody, the reason you're buying is something is going to go bad, right? So when something goes bad, the insurance company, right, indemnifies you. Well, this is a very similar process. A bank is also an intermediary in the same sense. It pools resources and then makes loans, and it takes the risk. So if, it's going to make loans to Jess and Megan and Linnea, right? And one of those people is probably going to default, bless you, is going to probably default on their loans, probably not going to pay. But all the depositors, Deb and Caitlin and Allie, when, say, Megan doesn't pay her loan back, the bank absorbs the losses and keeps on paying the interest that it promised to Deb and Caitlin, and they never know, right? If you make a direct loan to somebody, you are directly taking that risk, right? And so that's what intermediaries do. They assess risk. They're specialists at assessing risk, and they take on that risk from small lenders, right? So they aggregate together and they take on that risk from small lenders. So so just like retail banking or mortgage banking, where Jess is coming in to borrow money to buy a house, Aaron might come in and say, I want to, set up a natural food store, and I need $400,000 to build out this space, buy my initial inventory, have operating cash to run the business for some number of months until we can get it up and running, right? That's going to be a different part of the bank. I told you before, right? The banks typically have a retail side and a commercial side. So the bank will typically have a commercial side where there are loan officers who specialize in assessing the risk of businesses. And they assess, so if Aaron comes in and says, I want to, set up a natural food store, somebody in the bank is going to be a specialist in not necessarily natural foods, but in evaluating the retail market for the area. And this kind of lending is very local, right? It's very different to get a loan from a bank in your community for a business that you're going to run in your community, as opposed to trying to get it, so if you're going to set up a natural food store in Durham, right, you're not going to go to Hartford, Connecticut and ask for a loan. You're going to probably find a commercial banker in the Seacoast area who knows the Durham market, and will, because a Hartford bank is not going to lend you the money. They're going to, we don't know your market, we can't assess it. We can't assess the risk appropriately. So a lot of commercial lending is very local, right? There are, of course, national firms that do, bigger loans to larger organizations. But so we've been talking about commercial banking versus retail, right? So commercial banks, you have bankers who specialize in making these loans, in assessing the risk of businesses. So a minute ago, I was talking about that financial intermediary function. So that's one kind of lender. Banks are one kind of lender. The other kind of lender are bondholders, right? Or the bond market. So a bondholder is a lender. A commercial banker will typically make loans up to several $1 million, right? Let's say you might get a loan from a commercial bank, a large commercial bank of say $10 million. But if you are Wentworth Douglas and you need to build a new tower, meaning a new inpatient, building, a new building to have your inpatient work in, that's going to cost $150 million, let's say, just to be generous, $200 million. A commercial bank is not going to take that on because that concentrates a lot of their portfolio in one place. So, and that increases their risk, right? If they have all of their, it's a kind of an all your eggs in one basket kind of thing. And so most commercial lenders want to, what commercial lenders want to do is have a portfolio. They want to have lots of small loans spread out across a community, right? So that if we've got, who was I picking on? Megan has a business and Linnea has a business and Samantha has a business. What they want to do is have it spread out so that if Megan's business fails, Linnea and Samantha are still paying their loans. And so they can absorb one loss, but they can't absorb all, but if they loaned all their money to Megan and then she went belly up, right, then they would not be able to pay back Deb and Allie and Caitlin, right? So they build into their models when they make these loans, they make some assumptions that some of these businesses are going to fail and they're going to lose the money on the loan, right? So that's an example of an intermediary. But when you go up to the level of large loans, like $150 million to build a new facility, or $1 billion, right, to build a new factory, say, or something like that, like what's his name that builds the electric cars? Help me out. Elon Musk, right? So Musk wants to build a new battery factory in Nevada, which he did a few years ago, right? He would probably go to the bond market, right? So we call it the bond market. Right? He may go to the bond market and float a bond issue. And we will talk a lot more about all these things in finance too when we get there. But I'm just giving you a little bit of a taste right now because we're going to talk about bonds and loans and stuff going forward into chapters 3 and 4. And right now, you just need to know they exist. You don't need to really understand how they work all that much. What the bond market does is, instead of going through an intermediary where Deb and Caitlin and Allie lend money to the bank and then the bank makes the loan, a firm, a large company like a Wentworth Douglas or or why can't I think of what Elon Musk's company is? Tesla. Thank you, Tesla. I'm picturing it. I can picture the car, right? Okay, so Tesla, not Elon Musk, but Tesla, the company, right, makes works with what's called an investment banker to have a bond offering, right? A bond issue, and they're going to issue bonds in the market. And what that means is they're going to go directly to the market and sell bonds to individual investors, and as well as mutual funds and other investment banks will buy these bonds to hold them as investments. But you can go buy bonds that, the corporate debt is what it's called, corporate debt of, say, Tesla, right? You can be a bondholder of Tesla. You can be a bondholder for Wentworth Douglas, right? Those bonds exist out in the marketplace, and individual people or individual investment pools own those bonds. So let's imagine that Elon Musk is organizing a bond issue to build his battery factory in Nevada. That happened. And he says, I need $1 billion to build this factory. That $1 billion, no commercial bank in the world is going to make a $1 billion loan, right? And especially not to Tesla, even though they're doing pretty well. That's a, Tesla is one of those high-tech companies that if everything works out, you make a boatload of money, but they're really risky relative to, say, a more staid and boring business. So a commercial bank is not going to make $1 billion loan. In order to get $1 billion, raise $1 billion, and that's probably too big a number, but let's say, $500 million, $500 million. There's no one commercial bank that will do that. So what companies do when they need big infusions of cash, very often is they go to the bond market and they issue bonds. And so what they do is they'll issue a bond in the amount of, say, $1,000. So you could buy units, bonds in units, typically of 1,000, though can be 10,000, or different dollar amounts. But what I will refer to as a vanilla bond is going to be $1,000 per bond. And it's a loan. It is essentially a loan. You're buying these little loans of $1,000. And the way when you buy the bond, you are lending money directly to the company. So if Tesla issues $500 million in $1,000 bonds, you could buy one of those bonds. When you cut your check for that $1,000, that $1,000 goes through a process that we'll talk about more in depth next semester. But basically, that $1,000 goes to Tesla, right? So that becomes your loan to Tesla. And the bond, a vanilla bond, a basic vanilla bond, is a contract that says, you give me $1,000, you bondholder, give me $1,000, and every 6 months I will give you a what's called a coupon payment, a payment of cash. Let's say it has a $1,000 face value. What's called of $1,000. It has a coupon rate of, let's say, 10%. I'm using these are not realistic numbers these days, though they have been in the past. And it has a maturity of, say, 10 years. So this is the essential information you get to know about a bond. If you buy the bond at par, meaning you buy the bond at its face value, and again, we'll get into a lot more details because later on, because that often you don't buy it at face value. But let's say you do. You send the check for $1,000 into the investment bank that's managing the bond issue. The investment bank then takes that money and aggregates it all up and sends it over to Tesla. And then you start getting coupon payments from Tesla. And so in this case, the coupon rate is 10%. So every year you're going to get $100, 10% of $1,000. Okay? The way this typically works is you get 2 semi-annual payments. of $50 each, half of the overall coupon. The reason we call it a coupon payment is you used to literally get a coupon book. When you would buy a bond, you would get a coupon book in the mail. And it would be, and you would rip out a coupon, you would mail it to the company, and then they would mail you a check back for the coupon value. So if you, in the old days, if you had a $1,000, a bond with a $1,000 face value and a coupon rate of 10%, you would have 2 coupons a year to send in to the company, and you would send in coupon 1 at 6 months, and they would send you a check for $50, and then you would send coupon 2 at the end of the year, and they would send you another $50, so that at the end of the year you would have earned $100. And so it used to be you had these physical coupons that you would mail in. Those don't exist anymore. Now you just have an electronic contract and money gets transferred to your bank. But setting that aside, that's why it's called a coupon. Now, if you have a 10-year maturity, what that means is you buy the $1,000 bond today, and for the next 10 years, you get $50 payments, coupon payments, every 6 months until the end of 10 years. At the end of the 10th year, you get your final $50 coupon payment, and you get your $1,000 back. So that repayment is the repayment of your principal, right? So that principal is paid back to you at the end of 10 years. So if you are making a loan of $1,000, a bond is a loan, in this case, in this specific case, of $1,000 that you're making to Tesla. In exchange for that, you're going to get $50 in interest every 6 months for 10 years. At the end of 10 years, they're going to pay you back your principal. Right? So that last payment is going to be $1,050. It'll be the $1,000 principal back plus your final $50 coupon payment. And that's how bonds work. So if you get excited and you're like, I really believe in Tesla, I think that they're a good bet, and I think 10% is a really good rate to get, you could buy $1,000. You could buy into that $500 million or $1 billion bond issue in $1,000 increments. So you could hold 10 of those bonds for $10,000. You could hold, 100 of them for 100,000. You could hold 1,000 of them for $1 million, right? You could have, and you would get the respective, 50 times however many units in coupon payments. So you're not doubling your money. You're lending them 1,000, and at the end of the contract, you get the $1,000 back. So your interest is the coupon payments. So you're not doubling your money because you give them 1,000 and then they give you 1,000 back, right? So that's kind of a wash. Sorry. Right. So you will have gotten over the life of the loan, you give them $1,000, and then you get 10 times 100 or $1,000. So is that what you mean by a doubling? Well, okay, so that it's effectively, yeah, because of the numbers I picked, it works out that it's doubling. So yes, so over the life of the bond, you get $1,000 in coupon payments. 10% times 1,000 is 100 a year for 10 years. So I just picked numbers that happen to work out to double. Right? It could be 8% for 5 years, and then that wouldn't work out that way. Right? That's just an arbitrary natural result. The math there is a result of just me kind of arbitrarily picking simple numbers to work with. Yeah, absolutely. Those numbers are totally flexible, and that's one of the neat things about bonds is you can do all kinds of stuff with bonds, and we'll talk about that. But this very vanilla, what I call my very vanilla basic bond, is semi-annual coupon payments for some at some fixed amount, right? And in fact, one of the names for investing in the bond market is fixed income investments. So if you're an investor, you'd refer to this as a fixed income investment. Fixed income investment, because you're going to get a predictable flow of cash, which is one of the things that's appealing about owning bonds as an investor, is assuming that the company doesn't go bankrupt and default on payments, right? You're going to get $50 every 6 months for the next 10 years. So that's nice, right? A lot of a lot of traditionally, this is the kind of thing you would invest in if you were a retiree, or you were looking to get a nice steady flow of income. Question or distraction? Okay. Okay. These are not dividends, right? So a dividend is, okay, good point, and we're going to talk more about that. This is interest. Dividends go to owners. You are a lender in this case. So that's actually a nice, sorry? You're buying debt. So the question was, are these payments, these coupon payments, right, of $50 every 6 months, are these a dividend? No. Right? No, they are not a dividend. They are interest payments, because you are a lender in this case. If you are a bondholder, you are making a loan to the company. You are not an owner of the company. You are a lender to the company. A dividend is a payment to owners of the company. So you can own stock in Tesla, right? You can buy shares of Tesla. In that case, if Tesla pays a dividend, which I don't know if it does or not, I doubt it does. But if you own shares in Tesla and they paid a dividend, you would get that, you would be entitled to that payment, and that would be a dividend. But in this case, these are interest payments and they are not dividends. Okay? Good question though, because we will get to that, and it does matter. The difference does matter. Now, what's the difference between and so big loans, when a company needs a big loan, whether that's a hospital needing to build a new building, or a commercial firm like Tesla needing to build like a new factory, right? Once we get above a certain threshold, commercial banker is going to say that's too much money for us. We can't concentrate that much of our portfolio in your investment. You're going to have to go to the bond market to get a loan, right? And so then you are skipping. You're no longer using an intermediary. There are some intermediaries involved, but fundamentally you're not using an intermediary. What you are doing is you're going directly to the market and getting investments from individual investors who are buying your bonds and lending money directly to you. So whereas before, Caitlin and Deb and Allie gave their money to the bank, and then the bank made the loan to Jess, and the bank took on all the risk. So if Jess didn't pay back, then the bank was stuck with the bad loan. If you are a bondholder and you buy a bond, effectively lending money directly to a company, if the company defaults on its debt, stops paying, you are directly affected. You lose your money, right? There is no intermediary that makes you whole, that's promising to make you whole. So that's the difference between a bank acting as an intermediary. They take on the risk, right? This is kind of what we talked about last time with insurance companies, is the banks, like insurance companies, the banks take your money and then take on the risk. If you are a bondholder, you are making a loan directly to the borrower, and you are at risk. Okay? Emily, another question. Great question. So Emma's question was, is it the same market for corporate debt as it is for government debt? And so you probably heard that you can also buy bonds from, say, the federal government. You can buy bonds from the state. So the state of New Hampshire, the state of Massachusetts have bonds. You can buy local bonds. So often your county or city. So if you're from Boston, you can buy Boston city bonds, right? Sorry? A classic grandparent gift is your treasury bonds. So actually my in-laws give my kids every birthday, they get a savings bond, right? So that's a savings bond is a bond, like it's what we're talking about here. It functions a little bit differently. It's called a savings bond is a zero coupon bond. We will get into all that next semester, but it is a bond. And the federal government, and you can buy vanilla bonds that look like this from the federal government. Is it the same market? Broadly, yes. The answer is yes, broadly yes. The difference is really more about the quality of the issue. So the US federal government is considered a very, very, very low risk. In fact, we use it as a proxy for zero risk, right? Risk-free. We use the federal debt as a proxy for risk-free borrowers because the US government is so good at paying back and so disciplined about paying back its debts. Not so for every country in the world, right? Venezuela, really bad at paying back its debts. Argentina, really bad at paying back its debts. And so the interest rate that the United States pays is very, very low. The interest rate that Argentina pays, because it has a long history of periodically defaulting on its debts, is very high, right? And so that's what you see in the market. The same kind of investors who are interested in buying bonds are also going to be interested in buying corporate bonds. So you're going to typically see a bond. The bond market broadly refers to both government debt and corporate debt. Yes, and it comes down to the level of risk and reward, right? So very much this interest rate is determined by risk assessment. Right? And we're gonna, like I said, we'll get into a whole bunch in like chapter 13 or something about all this next semester. So what you need to know right now is when we look at financial statements for hospitals and so forth, we're going to see corporate debt in the form of bonds, and we'll see also bank loans in particular in chapter 4, right? In chapter 3, this chapter, we will see companies making interest payments, okay? So lenders, sorry. So as I said, businesses come into the market, they acquire capital, right? In order to do all this stuff, they have to create financial statements. So anytime you are borrowing money in the market, whether it's from a commercial bank or from the market more broadly as a bond, you are going to have to generate financial statements. Okay, so you are also going to have to generate financial statements. So that's the that we've been talking about debt, various kinds of debt, loans, bonds. You can also get financing through equity, which you can think of as stock, right? You can sell stock. These are lenders, right? Equity implies that you are an owner. So going back to Emma's question a minute ago, right? Lenders get interest, owners get dividends. But either way, you can, and those are two ways that you can go to the market and get your funds from the markets, get your resources so you can buy the stuff that you need to have to produce revenue, right? Which was the function, were some of the functions of the business that we talked about previously. If you are going to sell shares in your business, sell stock in your business, you are also going to have to produce financial statements, and they are expected to be standardized. And this is the key point. Financial accounting is standardized, right? It is standardized way of explaining how the business is doing, right? It is focused on external stakeholders. As opposed to shareholders, right? A stakeholder just simply means this is somebody who has an interest in the business in some shape or form. Employees are stakeholders, right? Obviously, you know, an employer, if you think about it, if you are an employee, you rely on a steady stream of income from the business you work for, whether it's a not-for-profit or for-profit, right? I rely on UNH to provide me a steady stream of income. I am a stakeholder in UNH's health. Doesn't mean I own it, right? But I have an interest in it. I would be an internal stakeholder to UNH, though, right? External stakeholders refer to typically owners and lenders, right? So if we think about it, if we're in a for-profit entity, external stakeholders are going to be shareholders and lenders. With a not-for-profit business, external stakeholders are typically going to be the community, but it could also be, you could think about in this kind of very broad idea of lenders, you could think of certain creditors who are, so if you're a business that relies heavily on getting expensive inventory, if you are buying your inventory, and this is not true of most healthcare organizations. Most healthcare organizations are service organizations. So we're not going to get into as much detail about inventory as we would if we were in a regular accounting class talking about manufacturing companies. But if you're going to be, getting a credit line if you were a manufacturer and you were going to be getting a credit line, and they were going to be fronting you a whole lot of very valuable inventory, it's conceivable that they could ask to see your financial statements and say, prove to us that you are not going to default on if we send you, millions of dollars worth of inventory, that you're really going to pay us back. That's kind of more rare. But you could say that some stakeholders might be, other kinds of creditors that take the form of, effectively take the form of lenders. So what we use financial accounting primarily to do is to communicate with external stakeholders, whether those are lenders or owners. And so the board of directors or the board of trustees of an organization is going to be reviewing, typically on a monthly basis, financial statements that summarize the overall financial health of the organization. So when Jameson goes to her monthly board meeting with Wentworth Douglas, the CFO presents the financial statements and they are unaudited financial statements. So they're kind of a running, this is where we see we're at. So where do these standards come from? This is what I want to talk about for a minute. And this is stuff that you should know, but I'm not going to test you on. Okay, but you should know this language because it is important. Financial statements follow GAAP, generally accepted accounting principles. I always get the LES or ALS. Accounting principles, generally accepted accounting principles, or GAAP. Okay. What these are is just, we all agree broadly on the structure of how we're going to report the financial condition of an organization. And so there are broad rules that tell the CFO of Wentworth Douglas how to produce his financial statements. And it is a he, and his name's Peter. There are these generally accepted accounting principles. Where do they come from? Right? Well, a piece of them come from the SEC, the Securities and Exchange Commission. This is a federal entity that oversees publicly traded companies. Right. So you have to follow SEC guidelines if you are a publicly traded company. So if you sell stock, if we sell stock, sorry, can you not read my writing? Publicly. Oh, okay. Companies. Security and Exchange Commission. publicly traded companies. Yep. SEC. You're going to hear about the SEC in the news, right? So if you are a publicly traded company, and your stock trades outside of your state. So we talked last time about all corporations have a home state wherever they are incorporated, right? So if you're incorporated in New Hampshire and you want to sell stock ownership of your firm, and you want it to trade in Massachusetts and in New York and so forth, you have to abide by SEC regulations, right? Because the federal government has oversight of interstate trade, right? That's in the Constitution. So, but more broadly, the SEC sets some of these standards, right? Kind of next level down is the Financial Accounting Standards Board, or FASB. FASB is a private standard setting organization, not a government entity. And it's a gang of accountants and lawyers that get together and make pronouncements and provide guidance on how to write financial statements, right? FASB provides guidance, right? Kind of high-level guidance. The American Institute of Certified Public Accountants. We're kind of going down a hierarchy here. Public accountants. The AICPA, right, is the organization that certifies CPAs. So if your parents get their taxes done by an accountant and they have a CPA, that CPA is certified by the American Institute of Certified Public Accountants. So my wife is a CPA. And the AICPA works with the FASB to work out, so the SEC is going to provide very broad guidance. FASB provides more detailed guidance on how to do certain things. The AICPA provides even more detail, right? So FASB provides so it's sort of like very broad brush, smaller brush, right? Progressively smaller and more detailed, filling in all the details, right? The thing is that financial statements, I told you before, day one, by the time we're done with this course, you're going to be able to open up and look at and have a general feel for any financial statements anywhere. And the reason is, from a very broad brush perspective, they all look the same, right? Very broad brush, they all look the same. They all have the same basic structure, right? There are a lot of details, though, behind what counts as revenue, what doesn't count as revenue, when do you count it as revenue? That depends on the industry, right? And so if you are a manufacturing company like Tesla, they make cars, right? As opposed to a nursing home that provides a service, your financial statements are going to look a little bit different. They're gonna have this very kind of the broad brush structure of an income statement and a balance sheet and cash flows and so forth. And those statements are going to have very broad brush kind of similarities, so that you could pick up, after I teach you how to read the financial statements for a hospital, you could pick up Tesla's and you'd have a pretty good idea what you were looking at. There are components that are different. And so as we progress down this kind of hierarchy and we're getting more and more into the weeds, the AICPA has industry-specific subcommittees that look at, automobile manufacturing companies and how do we govern the accounting questions around automobile manufacturing as opposed to the healthcare industry. And so they have a subcommittee on healthcare, right, that provides specific guidance on accounting for because there's never, like, revenue's revenue, right, kind of at this very kind of high level. But there's always kind of a that gray area that's very specific to an industry. And so the AICPA starts getting down into those weeds. And then the next layer down is for us, is the Healthcare Financial Management Association, or HFMA. So if you're interested in maybe pursuing a career in healthcare finance, you want to join the HFMA. This is a professional organization for people who work in healthcare and specifically work in finance. And they get down in the weeds of how to account for different transactions, right? And so kind of following, they are basically the bottom of the pyramid, or maybe if you think of an inverted pyramid, right, where these guys are the super specialists for healthcare accounting, right? And so, and there's obviously a lot of overlap at each level in terms of who's there and talking, right? But HFMA will provide guidance and probably provide people to work with the AICPA and their healthcare committees, right? And then the AICPA provides advice, and the people who are members of the FASB are almost certainly also members of the AICPA. So it's kind of this, moving back up into the generalities. There are professional organizations that do similar things for each different kind of industry. So HFMA is for healthcare, the super specialists that get into the deep weeds of, the detail about how to account for different financial transactions in healthcare financial statements. Okay, so HFMA, and by the way, there's a student rate to join HFMA. It's really cheap, and they have. Let me just pitch this. I think there's at least one of you is going to be working on it. Was you, Caitlin? So they have. You can get a certification from HFMA even before you graduate, called the Certified Healthcare Financial Professional, CHFP. It doesn't carry a whole lot of weight, but it is something that you can actually do as a student. It just involves joining, first of all, and then they have an online course that you take, and if you pass the course, you get your CHFP, which would be, when we start talking about your resumes and trying to differentiate yourself from your colleagues, all of whom have worked as a waitress and a nanny and a this and that, and when you're trying to apply for your first job as an analyst at Mass Eye, having that CHFP could make the difference, right? It will impress a hiring manager enough that they will probably ask you about it. What is this and why did you do this, right? And given that it's not super hard to get and it's not expensive, it's $50 to join, and then the certification is free if you're a member. I recommend it. I've been recommending it to the seniors as well. Anyway, HFMA, good organization. They have they have good people to meet and to network with as well. Okay, so you have this kind of hierarchy of very, very broad to super, super specialized for your industry, right? Because all industries, all organizations that go to the markets, right? And for those of you on Zoom, I'm waving my arms around. All industries have to have their financial statements if they go into the marketplace to get funds, right? But the accounting, the very details of how to account for, right? The transactions that happen in a hospital involve lots of insurance payments and different kinds of very detailed transactions, most of which are happening on credit of some sort, as opposed to Elon Musk selling $50,000 electric cars. It's very different. The revenues coming in are very different, and so they require a different kind of accounting. Even though at the end of the day, when you get back up to the financial statement level, you're going to see one line saying revenue, right? But the thing is that there's a whole lot of thought process that goes behind making that number and making sure that it's accurate. And so in order to make sure that the financial statements are accurate, we go through what's called an external audit. So there are accountants that specialize as auditors, right? Meaning what they do is Wentworth Douglas produces a set of financial statements internally, right? So they have internal finance people. They're very nice people. Some of them are HMP grads. So they produce a set of financial statements. They go through a process, a very organized process. They have all these books. They have computer systems now, not literally books, but computer systems that they use to assemble these financial statements. And they have to make certain judgment calls along the way, because even though you have all of these rules, right? And even though you have a CPA and you have all this experience, there's always these judgment calls about, does this revenue belong in 2019 or 2020? Well, it happened on, the encounter happened on December 30th, but the payment happened on January 2nd. So where does it fall, right? Is actually a pretty simple question, and you'll know how to answer it later. But those are the kind of, there's always some sort of thing that's down in the weeds that's gray, that there is judgment that has to be exercised. So firms are making those judgment calls, and then they're producing these set of documents called financial statements, which are then used by external stakeholders we talked about, lenders and owners, right? And those lenders and owners are like, we love our CFO, we love our finance people, they're all wonderful people. We still want their work to be verified because our money is on the line, right? As much as we like Taylor, the CFO, Taylor, the CFO of the company that we own, we want a second set of eyes to look at what Taylor's been doing. Because even though we like people, remember we talked about our friends who we would lend $10 to, it might turn out that Taylor, has been, siphoning off a couple $100,000 a year, to fund her vacation home in Aruba. So that happens, right? That really happens in the real world. So we have, and that's not the primary purpose of audit. It is one of the functions of auditing is to make sure that, that sort of thing isn't happening. But more to the point is all the gray stuff, right? Is to make sure that, Taylor isn't trying to shift stuff. If Taylor's the CFO, Taylor's not trying to shift money around from year to year, because there is a lot of gray, and that can be done to a certain degree. And so basically what external auditors do is they come in and they look at the organization's financial statements and render an auditor's opinion. Okay. So when you look at a real honest to goodness financial statement, one of the first things you're going to see is this financial statement has been reviewed by the firm of, Dexter and Bonica, and we provide and we believe that it has been done in accordance with generally accepted accounting principles, and we provide a unqualified opinion. And what an unqualified opinion means is it is fully compliant with GAAP. So an unqualified opinion is the best opinion that you can get from your auditors. So they come in, typically this is done once a year because it's expensive, right? Come in once a year, they do the audit. It's expensive. They spend a lot of time and a lot of resources. There's a lot of people come through, and it's a hassle because they're constantly going to Taylor and saying, hey, Taylor, why did you do this on January 4th? Why did you do this on August 17th? We don't agree with that. Tell us why you did that. Okay, we still don't agree, so you need to change it or we're not going to give you an unqualified opinion, right? That's what that process looks like, and it's unpleasant, right? And it's expensive because those guys, the auditors, make good money. Right, the firms that do the audits get paid a lot of money to do it. So the goal of, from the firm's perspective, is to come out with an unqualified opinion, which really simply means Not that the firm is doing well, right? But that the financial statements are accurate. They are accurate and they're compliant with GAAP. So they accurately represent the financial condition of the organization in accordance with the rules set out by GAAP. Okay? So an unqualified opinion doesn't mean that the firm could be on the brink of bankruptcy and still get an unqualified opinion, right? So it doesn't mean you're doing well. It just means you're following the rules and these statements are accurate. You could get a qualified opinion, which just means that the auditors and the CFO didn't come eye to eye on everything. The auditors and the CFO have a disagreement, and so the auditor is saying, the firm has produced these financial statements. We have some concerns that we could not come to agreement with the firm on. And then the third and really bad one is an adverse opinion, which basically means that the statements do not accurately reflect the financial condition of the organization because the firm has not followed generally accepted accounting principles. These opinions, again, are about the accuracy of the statements, not the health of the firm, right? The purpose of the statements is to communicate the health of the firm, but the statement itself, the auditor's opinion, does not make a judgment about whether the firm is doing well or not. It simply says this statement is accurate. Okay, so you always want to come away with that unqualified opinion. You want to comply. You want to work with your auditors to get there. So that's that. All right. So some conceptual framework I want to go through. Let's see. What are we looking for? What are auditors looking for? When they do an audit. So it's kind of a conceptual framework. First of all, we have what's called the matching principle. So when we do our accounting, we want to match expenses to revenues when they are related, to the degree that we can demonstrate. So we're going to report expenses as a matter of principle. We're going to report expenses during the time period that they are incurred in order to generate revenues. So let me give you an example. Dr. Aaron sees Samantha in her office, right? And Dr. Aaron does a test, a COVID test, and that COVID test costs her practice, Aaron's practice, $10. I don't know how much COVID tests cost. How much? 150 each. That's the cost, or is that the billable amount? Well, we don't know.
They're free if you have health insurance.
Sorry? They bill you 25. Cost. Okay, so that might be so Aaron might bill out 150 for doing the lab might bill out 150 for doing the test. But let's say the test itself actually costs her, I'll just say $10. Okay, we'll just go with $10. It doesn't matter what it is, right? I'm just going to say right now it's $10. So let's say she sees Samantha, right, and she does the COVID test. She bills Samantha $150. So that's her revenues, $150, right? And her costs are 10. She does the appointment on, what's today, September 17th? So she does the appointment on 9/17, right? And bills Samantha on 9/17. But she bought the tests. She bought a whole box of COVID tests on 8/25. We're going to recognize the expense when the revenue is generated. So we're going to recognize the expense on 9/17, not on 8/25. Even though she bought it, okay? Even though she bought the test on 8/25, we're going to recognize the expense on 9/17. And we'll get into a little more about that in a bit. It becomes really important when this is breaking across a fiscal year for the organization. So if she bought the test on 12/25 and did the test on January 17 and she was running on a calendar year, right? She would have bought it and it would have potentially, if we don't follow this matching principle, she would have recognized an expense in, say, 2020 when she actually did the test in 2021. Okay? That's going to become relevant in a little bit. But so bear that in mind. There's this idea that we're going to recognize expenses in conjunction with when they're used to generate revenue. So that's the matching principle. We want to try to keep them in the same accounting period. So if she had bought the test last year, and it was breaking across fiscal year. So a fiscal year is a year period that the company is running on. Companies do not necessarily have fiscal years that align with the calendar year. Okay, so some companies run. UNH, I believe, runs or July to June, right? So the UNH fiscal year starts 1 July and ends June 30th. A lot of companies the federal government runs October 1st to September 30th. So when I was a CFO in the government, we would always have a kind of a joke, and on September 30th, we'd order Chinese food and stuff like that in the office, right? To kind of, because that was the end of our fiscal year, right? So this becomes especially important when we are crossing fiscal years. And this gets into all that detail I'm talking about, right? That I was talking about a minute ago in this hierarchy of decision making. So that's kind of this is an example of an expendable supply, like a COVID test, right? Meaning an expendable supply means you're going to use it and basically use it up in the process of providing the service. So once you've stuck once Erin sticks the Q-tips up Sam's nose, she's not going to put them in the sink, wash them off, and then stick them up Taylor's nose, hopefully, and wash them and then stick them up Deb's nose, right? This is an expendable supply. It's a one shot. You stick them up the nose, you stick them in the thing, you run the test, you throw it away. Right? It's an expendable supply. But in healthcare, we have a lot of long-term, long-lived assets. So as opposed to an expendable supply that you're going to expense as you use it, we're going to have assets, long-lived assets, like X-ray machines, right? MRIs, operating room tables, hospital beds, and the list goes on and on and on and on, right? If you walk through a hospital and you look around, you're going to see all kinds of equipment that, gets used, gets washed, and then gets used again, right? And you use it over the course of many years. If you were to buy a MRI machine for, $1.5 million, and you were to charge your organization that $1.5 million in the year you bought it, it would look like you spent a lot of money. Let's say you bought a new MRI machine for $1.5 million this year, and you start using it, right? If you treat that as an expense in 2020, but you use it for the next 10 years, it's as if you had a $1.5 million expense in 2020 and then no expenses in 2021, 2022, so on out to 2030. when you have to buy your next machine, right? So that would distort your financial statements. It would look like you did really badly in 2020 and then were brilliant in all the years after that. So if Taylor, CFO Taylor reports, $1.5 million expense, it looks like the hospital lost money in 2020. We fire her, and then Jess takes over, right? And Jess looks brilliant because she doesn't have that $1.5 million expense in all the following years. And they're like, remember that old CFO Taylor? She didn't know what the hell she was doing. Look at Jess, she's brilliant, right? And so, but that would be an inaccurate statement, right? Because we bought that thing in 2020 and we used it for 10 years. And so this is a principle of matching. We're not going to expense the 1.5 million in the year we bought it for an asset that has a 10-year life. We're going to expense it a little bit each year. It's called depreciation. And we're going to expense it. We'll get more into that later. But I'm just trying to demonstrate why that matters, right? It would make the organization look really bad in the year you bought it, and then really good in the following years because there's no longer. So that we don't do it that way. We instead, with assets that have that are not expendable or have a life longer than 1 year, we break up the cost over the course of the life of the asset. Caitlin, you have a question? Right. So there are generally accepted accounting principles that you follow, that an MRI machine has a X number of year life. Then that's what you use for the financial statements. Whether that actually happens or not is kind of a separate issue. But when the auditor comes in and says, I see you have an MRI and you're depreciating it on a 3-year schedule, and MRIs actually have a 12-year schedule, you need to change that, right? Now, it doesn't matter. The MRI could blow up in year 3, and then you're just kind of out of luck. But that's a separate kind of operational issue rather than a financial issue. That makes sense? Or an accounting issue, I should say. No, it's definitely a financial issue. It's not, but it's a different issue for accounting, right? All right, so we have these long-lived assets that we're going to do. It would be inaccurate to fully expense them in the year that we bought. Imagine you build a new building. It costs $150 million. That would look like a really bad loss in the year you build the building if you take the $150 million hit, the $150 million expense in the year you build the building. Especially since buildings are depreciated on a 39-year depreciation schedule. So you build your building for $39 million to make it easy for me, and you take $1 million in expense each year for the next 39 years. Does that make sense? Okay, and we'll get into more of that later. So, matching principle. Full disclosure is another principle of financial accounting. And this simply means that the financial statements reflect a complete picture of the economic events affecting the organization. There are some detailed constraints on full disclosure. You're not going to have to know these. You should be generally familiar with these ideas, but you are not going to be. I'm not going to test you on them. And they are materiality, which basically says, look, we realize that you could spend all day and all night and have an army of accountants to account for every single little nitnoid thing that happens in the organization. We don't expect that. We only want you to capture the material events, right? The things that have real substance, right? There are things that are just too far down in the weeds that we're just going to kind of gloss over, right? And there's kind of an appropriate level of that materiality depending on how big your organization is, capturing those expenses. So materiality, there is a cost, kind of going with that, there is a cost benefit consideration, right? Collecting and reporting financial information is expensive. You have to have highly paid people like Taylor on your staff right? CFO, I told you, is like the second highest paid person in the organization. If you have that person spending all of their time cranking out financial statements, that's a lot of money. And they need a whole army of people to do it. So that's expensive. So there's this cost benefit analysis that kind of is allowed to be considered. There are some other ones that I'm going to ignore, but materiality and cost benefit are kind of the two big ones to consider. All right, we're going to stop there today. We will finish up kind of the background stuff next time, and then we will actually look at the income statement of a real organization. All right, Zoom people, we'll talk to you soon. End the meeting.